this video, we are going to discuss something about not-for-profit organizations. The concept of NFPO are divided into 4 parts. In the first part of NFPO, we are going to discuss about the meaning, its features, difference between NFPO and profit-earning organizations. Let me tell you one thing, this chapter carries a weightage of 10 marks in board exams. The possible number of questions is 3, but it depends on board how they adjust these 10 marks in board exam. The possible number of questions I told you is 3, 1 of 1 mark, 1 of 3 marks and 1 of 6 marks, but it can change. Let us start with the meaning and the features of NFPO. Meaning: NFPO, that is not-for-profit organizations, are those organizations which are established for a charitable or social purpose and not with a view to earn profit. They include schools, colleges, hospitals, public libraries, clubs, literary societies, sports associations, etc. As these institutions are legal entities established for the welfare of the society and not with a view to earn profit, so these institutions do not prepare profit and loss account. Instead, they prepare receipts and payments account, income and expenditure account and balance sheet. In final accounts of NFPO, we are going to face receipts and payments account, income and expenditure account and balance sheet. Let us go through the features or characteristics of NFPO. Separate entity. Yes, these organizations are not owned by individuals. Rather, these are separate legal entities distinct from individuals who manage them. Render services is another feature. These organizations provide service to the society or to its members either on free of cost or on nominal charge basis. Since the basic objective of NFPO is to render services such as social, religious, educational, charitable, etc., so they take the form of clubs, schools, colleges, societies, trusts or charitable bodies. No profit motive. Yes, we are talking about not-for-profit organizations, so they never aim at earning profit. These institutions do not operate with a view to earn profit. Rather, their aim is to promote education, sports, charity, religion, culture, etc. These organizations may also operate in trading activities with a view to earn profit, but the profit so earned is used to promote the objective for which these institutions are established. Funding. These organizations collect subscriptions from their members, grants from government, donations, income from investments, etc. to meet the operating cost and the cost of projects undertaken. Accounts. I have told you earlier also, they prepare the financial statements at the end of the year, and 3 things are there in the final accounts of NFPO. 1 is receipts and payments account, 2 income and expenditure account, and 3 is balance sheet. These organizations are generally managed by committees elected by its members. The capital of these organizations is called capital fund, general fund or accumulated fund. At the end of the year, whatever the amount of surplus is there, surplus means the excess of income over expenditure, will be added to capital fund and it is not distributed among its members. And similarly, if any deficit is there, that is excess of expenditure over incomes, so that will be deducted from the capital fund. Let us go through the difference between NFPO and profit earning organizations. The first point of difference is based on the objective. The objective of NFPO is to serve its members and public at large. But the objective of profit earning organizations is to earn profit. Funds point of view, for NFPO, it is called the capital fund. Surplus during the year is added to capital fund. And please remember, if any deficit, that will be deducted. In case of profit earning organizations, the capital is owned by the proprietor or the partners. The profit is distributed among the owners or the partners in the profit sharing ratio. Third is the financial statements. In case of NFPO, I have told you in my previous slides also, it includes receipts and payments account, income and expenditure account and balance sheet. But in case of profit earning organizations, it includes trading account, profit and loss account and balance sheet. What is the result of the annual activities? In case of NFPO, it is called as surplus or deficit. And in case of profit earning organizations, the difference of profit and loss account is either net profit or net loss. What is included in final accounts of NFPO? I have told you these will include the receipts and payments account, income and expenditure account and balance sheet. We are into part 2 of not-for-profit organizations. In part 1, we have discussed the meaning of NFPO, features of NFPO, the difference between the not-for-profit organizations and the profit-earning organizations. We are going to discuss something about the final accounts of NFPO. Receipts and payments account, income and expenditure account and balance sheet. Let us start with. The first account is receipts and payments account. Receipts and payments account is a summary of cash and bank transactions during an accounting year of a NFPO. Receipts and payments account is prepared at the end of the year from the cash book. So, base of preparing receipts and payments account is nothing but cash book. It shows the summary of cash and bank transactions. Receipts and payments account includes all receipts and payments of cash, including bank, despite the fact whether they relate to current year, preceding year or future period, or whether they are capital nature or of revenue nature. It's very important to note over here. You talk about receipts irrespective of the nature, irrespective of the year. In the same way, you talk about payments irrespective of the year, irrespective of the nature. So any receipts, any payments are going to be recorded over here in this account. Let us go through the features of receipts and payments account. First is the nature. We all know that it is a summary of cash and bank transactions. So it is going to be a real account. Since receipts and payments account is a summarized form of cash book, so it is a real account. Thus, all receipts are recorded on the debit side and all payments are recorded on the credit side. Basis of recording. All receipts are recorded on the debit side whether they are of capital nature or revenue nature. Similarly, all payments are recorded on the credit side whether they are of capital nature or revenue nature. The basis of recording is cash basis. Balances. It starts with opening balance of cash in hand and cash at bank. Cash always has a debit balance, while bank may have a debit or a credit balance. Credit balance will be bank overdraft. Similarly, closing balance also represents cash in hand and cash at bank. No adjustments. No adjustments for outstanding, depreciation, accrued income, etc. are made in it. In fact, all the transactions are recorded on the cash basis. We all are aware of adjustments are to be taken care of when we follow the accrual assumption. But because we are preparing the receipts and payments account on cash basis, so no adjustments are to be taken care of. Period. It covers a period of accounting year. All receipts, whether related to current year, previous year or future year, are recorded on the receipt side Similarly, all the payments made during the year are shown on the credit side, whether they relate to current year, previous year or future year. What is the purpose of preparing receipts and payments account? Receipts and payments account merely depict cash in hand and cash at bank at the end. It does not represent the axis of income or expenditure and vice versa. With the help of this receipts and payments account, we just come to know about the cash balance or bank balance at the end of the year. We cannot come to know about the surplus or deficit. Let us go through the difference between receipts and payments account and cash book. The first point is on the basis. Receipts and payments account is prepared on the basis of cash book, and cash book is prepared on the various receipts and various payments. Date. In receipts and payments account, it is a summary of cash book and we don't record the transactions date wise. But in cash book, the transactions are recorded date wise. LF column. Receipts and payments account has no column of ledger folio, but cash book has cash and bank column. No distinction is maintained between cash and bank columns in receipts and payments account. But in cash book, we have separate columns for recording cash and bank transactions. Who prepares receipts and payments account? So we all know that it is basically prepared by not-for-profit organizations, and cash book is prepared by both NFPO and profit-making institutions. What are the two sides in receipts and payments account? So we call it as receipts and payment side. But in cash book, we call it as debit and credit side. Let us go through the income and expenditure account. Income and expenditure account is a nominal account. It is prepared to depict the result of not-for-profit organizations during an accounting period. The principles of preparation of P&L account applies for the preparation of income and expenditure account as well. It is prepared on accrual basis of accounting based on principle of matching concept. That is, adjustments relating to outstanding expenses, prepaid expenses, accrued income, income received in advance and depreciation are made. Just because we follow the accrual assumption as well as it is based on the principle of matching concept, we need to take care of all these various adjustments. Incomes are always shown on the credit side, whereas expenses are always shown on the debit side. There is no opening balance in income and expenditure account, but the closing balance reveals the surplus if there is an excess of income or expenditure, and it will reveal the deficit if there is an excess of expenditure over income. Let us go through the features of income and expenditure account. Nature. We know the nature of income and expenditure account is of a nominal account, and that's why expenses are always debited and incomes are always credited. Period. It is prepared for an accounting period, so all expenses and incomes pertaining to accounting period are shown whether paid or due. We need to restrict ourselves to the incomes and expenses of current year only, whether paid or not. Adjustments. Yes, we need to take care of all the adjustments. Income and expenditure account is prepared on accrual basis, so adjustments related to outstanding expenses, prepaid expenses, accrued income, income received in advance are made. In the same way, we need to take care of provision for doubtful debt and depreciation as well. It does not include the capital expenditure and capital receipts, as we have earlier seen in case of receipts and payments account, irrespective of the nature of item. So, receipts and payments includes the capital expenditure, capital receipts, revenue expenditure, revenue receipts. But when you talk about the income and expenditure account, it will never include the capital item. Both cash and non-cash items like bad debt, depreciation are taken into consideration in income and expenditure account. If any fixed asset is sold during the year, profit on sale of asset or loss on sale of asset is shown in income and expenditure account. Result, we know the difference at the end of the year will be surplus or deficit. The balance of income and expenditure account at the end represents either surplus or deficit. It is transferred to capital fund in the balance sheet on the liabilities side. Income and expenditure account is followed with balance sheet, which consists of personal and real accounts. Because all the nominal accounts are closed by transferring to income and expenditure account, so we are left out with personal and real accounts, which are to be shown in the balance sheet. Difference between receipts and payments account and income and expenditure account. A very important difference between, keeping in mind those one marker questions. First point of difference is nature of account. We know like receipts and payments account is a real account, whereas income and expenditure account is a nominal account. In receipts and payments account, we have a summarized form of cash book, and whereas income expenditure account is similar to profit and loss account of a business entity. On what basis you record the transactions in receipts and payments account? On cash basis. Whereas in income and expenditure account, we record the transactions on accrual basis of accounting. Capital and revenue item is the next point of difference. Receipts and payments account will include both capital and revenue items, but income and expenditure account will include only revenue items. Fifth point is of period. Receipts and payments account will include receipts and payments made during the year, whether they relate to past year, current year or future year. But income and expenditure account will have expenses and incomes of current year only. The next point of difference is opening balance. The opening balance represents cash in hand and cash at bank, but income and expenditure account does not contain any opening balance. The sides. In receipts and payments account, we have receipts side and payment side, the debit side and the credit side. But in case of income and expenditure account, we have expenditure on the debit side and incomes on the credit side. Closing balance. In receipts and payments account, the closing balance will represent the cash and bank balance, but in case of income and expenditure account, it will reflect the surplus or deficit. Next point of difference is adjustments. In receipts and payments account, we are not supposed to do any adjustment because it is prepared on cash basis. But in case of income expenditure account, because it is prepared on accrual basis, we need to consider all the adjustments related to outstanding expenses, prepaid expenses, outstanding income, pre-received income, depreciation, bad debts, etc. Balance sheet. Receipts and payments account need not to be accompanied with balance sheet, but generally in case of income and expenditure account, it is accompanied with balance sheet. Transfer of closing balance. The closing balance from receipts and payments account is transferred in the balance sheet on the asset side, whereas from income and expenditure account, the difference is either surplus or deficit, which is transferred to capital fund in the balance sheet on the liability side. Let us go through the balance sheet now. Balance sheet is a statement drawn on a particular date to depict the financial position of an organization. This is the main objective of preparing the balance sheet, to know the financial position of an organization. The position revealed by the balance sheet is true only on a particular date, as it will change with a change in the transactions. The excess of assets over liabilities is called capital fund. Let us see what all points are to be kept in mind while preparing balance sheet in the absence of trial balance. Assets. All the fixed assets appearing in the previous balance sheet, that is opening balance sheet, have to be adjusted for assets purchased, sold and depreciation charged. The adjusted amount will be shown in the closing balance sheet. Let us see how are you going to adjust these amounts. New assets purchased during the year are added to previous year's asset. Second, if an asset has been sold during the year, the book value of such an asset must be deducted from the concerned asset. Please remember the book value, not the sale value. Next, depreciation of assets must be deducted from the concerned assets. So these all are important points while preparing the balance sheet. Prepaid expenses and accrued incomes. We know like these are assets, so to be shown in the balance sheet on the asset side. Investments is shown on the asset side. Again, like fixed assets, if any addition is there, that has to be added, and if any sale is there, so that has to be deducted. But the sale of investments to be deducted will be at its cost price, not the sale price. Cash and bank balance of receipts and payments account at the end are shown in the balance sheet on the asset side, but if it is a bank overdraft, it will be shown in the balance sheet on the liabilities side. Let us go through the liabilities now. The loans appearing on the liability side are shown in the new balance sheet. We need to have a check from receipts and payments account. If the loan has been paid during the year, it should be deducted and new loan raised be added to loan account to find out the net amount of loan. Donation for specific purposes like donation for building, prize fund, tournament fund be shown in the balance sheet on the liability side. Similarly, special funds created to meet specific expenses are also shown on the liabilities side after adjustments. Let us assume that we have tournament fund of rupees 20,000 and we have paid some expenses rupees 16,000 for tournament expenses. The balance left out is rupees 4,000 and this amount of 4,000 will appear in the balance sheet on the liability side. So this is what I was telling you, like if any amount is left out after the adjustments, this will appear in the balance sheet on the liability side. But if fund has a negative balance, it is to be taken to income and expenditure account. Let us take an example over here. I just reverse the values. Let us assume that tournament fund is rupees 16,000 and tournament expenses is 20,000. Fund is 16, expenses is 20. So this is going to show a negative amount. So this negative amount will be shown in income and expenditure account as tournament expenses. Outstanding expenses and unearned incomes. Unearned incomes is income received in advance. We know these are liabilities, so have to be shown in the balance sheet on the liabilities side. Surplus, that is excess of income or expenditure, is added to capital fund, and if you have a deficit, so that will be deducted from capital fund. This is also very important. Like if capital fund is not given, old balance sheet is prepared and excess of assets over liabilities will represent the capital fund. Thank you so much. I'm sure I have made myself clear with the concept of the financial statements of not-for-profit organizations. In the next video, that is part 3, I will be discussing something about the important items in NFPO. Do not forget to like, share and subscribe my channel. Thank you. God bless you all.